A surprise move by the Swiss National Bank and a big quantitative easing program from the European Central Bank. What are the implications for our investment strategy and on our mandates? Here to discuss this with us are our Global Chief Investment Officer, Michael Strobaek, as well as José Antonio Blanco, Head of Multi-Asset Mandates. The year started off with a surprise move from the SNB, a big quantitative easing from the ECB. What are the implications?
Well, it was indeed a surprise that the SNB decided to take the 1.2 floor away at this point in time. We're convinced that the events are linked, however, that the SNB came to the conclusion that their strategy was going to be unsustainable over time, and therefore the floor was removed with a strong reaction in Swiss equities, the Swiss franc, and yields going more into negative territory. The implications are clear, and that is that for Switzerland it is now an economic shock. Export-oriented firms are losing earnings, and we saw equities in the first hours down by 14%. They settled the day on 9%, which is an expression that investors were taken by surprise, and something now needs to adjust. The ECB announcement that we heard last week was in and of itself not a surprise. The implications are that European equities in particular are going to be well supported for as long as this program is running. It has been announced as practically an open-ended program until the ECB sees inflation coming back. And if the experience of the US has any validity here in Europe, it means that probably core European bond yields will begin to drift up, whereas the spread between the core and the periphery is going to contract.
Okay. And José Antonio, in terms of the SNB's announcement, what kind of an impact does this have on discretionary mandates?
Well, most of the impact was, of course, on Swiss franc reference portfolios, both because the Swiss franc has appreciated quite dramatically, about 20% relative to the euro, roughly 10%, although it's been moving recently relative to the US dollar, and also the fact that Swiss franc reference portfolios tend to have a higher allocation to Swiss equities, which also actually corrected quite dramatically. It was nearly a non-event for all other reference currencies. Actually, if anything, we had a slight positive result based on that, because if you had any investments out of another currency in Swiss francs, you would actually kind of have a small gain. For example, even if the Swiss market, which is one of our interesting markets from our point of view, if you had Swiss equities in your portfolio, actually the losses which happened on that day were more than compensated by the currency move.
And what about 2014? Because last year wasn't necessarily a very easy year to make money in financial markets. What were some of the big decisions that you had to make in terms of running these mandates?
It was challenging indeed, because we had a number of issues, including the fact that we have a continuous discussion about monetary policy, fiscal policy. Growth doesn't seem to be very strong. It was positive, but outside of the US was weak. We have the discussion about the Eurozone, which kind of is really getting some additional fuel right now. There are some geopolitical tensions. But actually, financial markets did relatively well. They were a bit kind of up and down. So what we did is two things. One is we tried actually to be a bit more dynamic. So we change relatively often our allocation, although in small steps, because we wanted to be able to react to the information that was coming in, and also to the fact that the markets reacted in a way which was very often wrong. And secondly, also to make sure that we actually exploit the regional differences, which are quite extensive. In particular, we are looking at the difference in monetary policy, where the US is getting a bit more restrictive and the other main markets are getting a bit more easier to play it and exploit it in terms, for example, of the performance of the equity markets.
And so looking forward into 2015, I mean, there's already been quite a few moving pieces. What does our investment strategy look like for the rest of this year?
Well, we've gone into 2015 with an overall neutral allocation to equities, and we have more focus on regional specific opportunities. We continue to like Europe, which we believe is now well supported by the ECB action. We continue to like Japan, and we also have an overweight in Australian equities, and we counterbalance all of this with an underweight to emerging markets. So the risks that we're taking are within countries and not on asset allocation so much. We're neutral overall on fixed income, i.e. we don't take much interest rate risk in our portfolios versus our benchmark at this stage. but we do expect yields to begin to drift up over time. And therefore, at some point in time, we will become more cautious again. And lastly, we're neutral on commodities. We do want to see the effects and the full implications of the sharp drop in oil, iron ore, copper before we take a new position. We've come down a long way, and we believe we are closer to a bottom in oil price than we certainly were 3 or 4 months ago. And now we'll see where are the biggest opportunities because of this.
Okay, thank you very much.
Thank you.
You both. For more information on market moves and the latest global trends, check out News and Expertise on the Credit Suisse website.